This is Efrem Hoffman broadcasting live from NakedSwanTrading.com. And what you see in front of you right now is a price chart of XOM. And ConocoPhillips, the activity that occurred over the past few days, is going to be a pilot light indicator for what's in the cards for XOM. And what I mean by that is I have overlaid a risk window on this high-definition risk map. Okay, and it's going to lay out the forward-looking risks between May and well into next year. And what you're seeing on this screen are not Bollinger Bands or forward projections of activity from the past. They're not moving averages that have been projected based on past behavior. What these boundaries represent is real supply and demand and liquidity of traders across a multitude of time horizons, right from the tick level all the way to multi-generational traders and investors. And these lines represent balance points of zero momentum, as will be seen in the MACD indicators of traders on different time horizons. Each colored line represents a different time frame. The lines that appear to extend further out into the future are traders from a longer time frame, and the shorter lines are traders from a shorter time frame. And the boundaries that you see moving very, very quickly and in a noisy way, those represent higher frequency traders, okay, where small changes in price cause the activity to bend in their MACD indicators. Okay? Normal MACD indicators will end on the current price bar, whereas these boundary conditions or isobars of zero momentum, kind of like on a weather map where you have isobars of equal pressure, here instead of talking about pressure, we're just talking about what would the zero momentum line price look like at each point in the future for each related time frame that is actually studying their own indicators. And for example, let's imagine that this yellow line represented traders from a weekly chart. Then it means that if you put a weekly chart on, for example, and if price was to land anywhere on this yellow line, okay, anywhere on this contour, then basically the MACD indicator at that specific point of time in the future would indicate that it is crossing zero. This is very valuable because it basically means that by knowing the shape of this boundary, it tells us that even if price was to go sideways, the perception of price would become more bearish over time because the distance between the zero line and where price is expanding into the future. When lines are bending downwards and slope downwards, then a zero movement in price would actually cause traders on higher time scales to actually interpret positive momentum. So really what we're doing is we're identifying how perceptions of momentum change over time and across all time scales. And by overlaying that all on one chart, rather than looking at each time frame separately on a MACD indicator that always ends on the current bar and isn't forward looking, we're able to kind of play a chess game with the market, almost like game theory, and try to figure out if I make a decision at this point and a trader does this, then what would the consequence be? And we could kind of map out those consequences in very short order. And the way I do it is that inside of this risk box, when we get a confluence of boundaries that are crunching inside of it for many different time horizons, and they're all beginning to slope up, meaning the shape of perceptions of negative momentum become greater in the future. And right now, price is over here, right? And it's May the 1st. But as we get after May the 7th, we get into a situation where there could be some drastic activity. All we really require is a full day range of prices, meaning the high of price would have to trade below 87.50 for one day at any point, okay, in the next 12 months. If that happens, then basically you could get a sharp acceleration down to the first area of support, which is basically at the $82.40 mark. Not a big deal, right? Because, I mean, we've already had some consolidations between the high 80s and the low 80s. So that's not the end of the world, right? But the real risk comes in where you get these confluence of boundaries that are kind of riding on top of each other. And what happens is if we were to get any full day's range, so it means a full day, the high of a bar being underneath at any point after May the 23rd especially, it could be before then, but definitely after May 7th, but after May 23rd, if you get a high of a bar below $80.85, okay, you are going to see a drastic expansion in volatility to the downside, okay? We call these breakpoints in this high definition risk map volatility attack points, because that's where the volatility attacks the market and changes the behavior. In system theory, they call this a regime shift. It means the statistical properties of the system that preceded it break down. The symmetries and the multifractal behavior, which basically means the replications of patterns that allowed the trend to manifest itself over a period of years to the upside, actually starts fading away when we actually get this downside attack point breached. And when that happens, then we're going to start getting an acceleration down below the 80.46 area. And we should get a sharp burst very quickly down to the first area of support being $74.74. The dangerous part is, if at any point after May 23rd, but especially after July 9th, you trade underneath 74.69 on a full day's range for even just one day, this market will have such an expansion of volatility to the downside, a lot of traders won't be able to see straight. And we're talking about a move down between 58.14 and 55.26. And for a stock that has such a large capitalization, it will have tremendous impact on the S&P, on the Dow, and any other oil indice that it is in. So the ramifications of this stock is tremendous and will act as a pilot light indicator for the rest of the market heading south. So let's look at the other side of the equation. In the event that we don't break these levels, from a trader's perspective, as you get closer towards the 88.46 to 91.71 to 92.80 area, those are the places where people who want to go short should be looking at their strategies to see if they have signals. Because any trading system that actually has a sell signal inside this risk window is going to actually perform better than usual, just because the underlying nature of the market and the way the demographics and ecology of traders are oriented will allow for short trading strategies to actually work effectively in that zone. Okay? In the event that the market is exceptionally strong and we actually get a gap up to, say, $95, then that would be about the highest you could go. But that would only last probably no more than a day and immediately would collapse. So from a stable point of view, the trading range is really 92.80 to 87.50. And you break out of that, then you get to this lower area. You break out of this lower area, you're in real trouble because you're breaking below 80, 85, 80.46, and then the whole market starts falling apart. So this is just a heads up of what to expect. It's basically letting investors know not to get too excited about the rally, because May is going to be a tough period. It's going to be a tough period for technology as well. Most likely somewhere after May 7th especially, possibly as early as May, starting somewhere between May 2nd and May 7th would be the initiation of a reversal to the downside in the market. And then if you break these key levels, in oil, that could really put a damper. And that's all it means is that if there are sectors, a few sectors that are performing okay during the middle part of the year into September, it's just basically narrower and narrower few groups that are participating in the bull run. But this bull run is really losing steam in terms of its breadth, and by the time you get into the the December period and into January 2013, it's not just stocks like Exxon, that will be in trouble at breakpoints, but it's pretty much right across the board. I've analyzed over 10,000 different securities across various global markets, and what I am seeing right now is a liquidity crisis developing, as well as a concentrated trade across very many industry groups, asset classes, and stocks, which basically means we're going to get to a point late next year through, late this year, like after December, and especially through the first and second quarter of next year, where any reversals to the downside could be very, very threatening. You could even get getting a break below the 10,000 area on the Dow and heading into below 8,000 as a real possibility for 2013. But the volatility leading up to that is going to be more to the downside, and the upside volatility is going to be less pronounced when you're at the top of these kind of risk windows. Now, of course, if you have a big drop down to the middle, between the top and the bottom, then of course you could get volatility bounces. The bounces on ExxonMobil will be contained based on this purple boundary. It's this purple boundary that relates to the trading signature that we have right now. So as prices do come down once we break these critical levels, this purple upper boundary will act as the trailing stop for the trade, which basically means that at any point in the future when price rallies and has retracements inside the downtrend, they will be stopping very, very sharply at the upper purple line. The upper purple line is starting at a value of around 88.37, but it will, as prices descend down and break critical levels, they will start descending, and then you could basically move the stop down quickly, as well as identify good trend continuation signals. The same kind of risk map applies on the upside. We still call it a risk map because it's the risk to the short sellers. Right now on ExxonMobil, this is an example of the risk for long-term holders in this equity. So I thank you all for listening to this clip, and I look forward to giving you future updates and free webinars at nakedswantrading.com. You could also follow us on the Twitter feed at nakedswantrader, all one word. And I look forward to having you tune in again shortly, and we will keep you updated on future risk warnings as the market further develops. Thank you. Bye. This is Efrem Hoffman broadcasting from nakedswantrading.com. And I just want to give you an immediate update on a critical risk window for short sellers that have been short all day.